31st of March, Friday. Once again, guys, I got a special technical analysis to share with you today. Now, this is a very important video, and if things really happen according to what I'm saying right now, things can get very scary, because if Federal Reserve really cut rates, the S&P 500 could really drop to 3,200. Now, where we are now, we are at 4,050. To drop to 3,200, that is catastrophic. But the thing is it really possible? Well, based on history from 1960 until to date, it is actually possible. So that means that this bull can turn out to be a bear market again. So that's the reason why I'm going to share this with you. But do note, once again, I'm just sharing if the Federal Reserve really cut rate at an inappropriate time, things can get very serious. And once again, disclaimer apply as usual. Thank you, AIMS, for the kind sponsorship. Now, let's go back into history. Since 1960s until now, right? This is the accumulated performance of the S&P. And you can see that most of the time when the market goes up, it goes up by 50 to 60 to even 500%. That is during the very incredible time, okay? So let's just take a look here itself. Like example, from 1985 to year 2000, the S&P rose by 582%. Well, that's incredible. But at the same time, back then, there were a period of time whereby the market drops basically about 33% on average. Some of them can be worse, up to 48%. All right, but majority itself has been 30 to 40%. Now, the one in this bowl are the number of months it took. So in this case right now, from 1985 to year 2000, okay, they took about 147 months to accumulate 582%. Got an idea now? Okay. So what happened recently during the pandemic time? Okay, during the Lehman Brothers time, in fact, you can see that the number of years it took about 13 months, about 1 year and 1 month, and the time the market dropped by 51% during the Lehman Brothers time. Okay, got an idea now? Okay, what I want you to focus now is this. The average losses in a bear market, and that number here itself is 34.33%. Okay, 34.33%. The time it takes about 11 months. All right, so this is going to be very important throughout this PowerPoint video. All right, okay, let's go. Now, first of all, why the bank can't cut rate? Now, let me show you this historical pattern. See, when the Federal Reserve increase rate, okay, you don't see much movement, but the moment you see they start to cut rate, right, this is because it's versus the maximum drawdown. Yeah, you can see that the maximum drawdown the last time was down by 27%. And the same thing is over here back in year 2009, whereby when the Federal Reserve cut interest rate, the maximum drawdown could be as much as 56%, 44%, 15%, and so forth. So that means that whenever the Federal Reserve cut interest rate, the scary part of it is that the market actually dives. Now, it's very contrary to what everybody wants now, the Fed to cut rate. But people forgot that historical pattern have shown that, right, cutting rates will lead to panic selling instead, because that means that the market is feeling very uncertainty right now. And most likely, the reason the Fed cut rate is because recession is already happening. So if you look at it again, this is the gains and after cut. You will notice that, yes, after it cuts, there will be drawdown. Then after that, we will see the rally. So that is not wrong. After cutting rates for a while later, after the sell-off first, eventually the market bottom out and the market will gain and profit handsomely from there. So it's not wrong that cutting rate will help the economy, but there's something that must happen first, and that's the drawdown that I'm sharing, okay? So this is something that you must understand where this video is coming from, okay? Because now what we can see is this. The US 2-year yield and 10-year yield, the inversion is now turning up. I repeat, yes, it's turning up because of recent movement. So this is very normal, right? Once you have this inversion, we know that recession is nearby. And as I said again, based on statistics, right, by August 2023, we should be basically having this number back to the zero mark. And that is where usually you will have your recession. So that's the reason why, mathematically speaking, by August to this September period this year, recession will be on the table. I understand that the GDP numbers now is still positive, but we all know internally this number should be a negative, but somehow someone is creatively doing something. We're going to leave it there, not to go down to it, but let's just look at this thing right now. The job market could deteriorate further because now we can see that it's picking up. The percentage of US states with unemployment claims is rising significantly. Can you see that? It is, even though people are not really feeling it, but you can see it's moving up in terms of percentage. So now we're very near to what happened in 2019, and this can continue to go higher. And you can see whenever the number goes up, can you see that? You can actually feel that it's coming in. So the total claims now is still low, but the percentage is moving up already. And when that all happens itself, recession will be on the table. This is why I'm pretty worried. So if you look at it right now, the Federal Reserve normally cuts soon after the 3 months and 30 years curve start to steepen. So when it starts to steepen itself, right, it's about 6 months, 6 weeks to 8 weeks, right? So it's probably about, in this case right now, it's about 2 more months to go. So where we are right now, right, we are now in start of April. So end of 2 more months, that is where things will get very choppy. That will be in June, July period. And if that continue a bit, by August, we should see the full blown of it. So all this information, you don't get to see this from the mainstream media, even though it's covered in Bloomberg, you don't see the mainstream media talking about it because these are all potential problems and usually the news doesn't really cover it as much. So based on what we are seeing right now, right, the rate cut will come in usually 6 months after the CPI peak. So rather than you expect to go down to 2%, usually, right, by 6 months after the CPI peak, right, they will usually start to cut. That's the reason why Wall Street now is betting that there will be a rate cut later this year. All right, because we have seen it in historical pattern, it has always been repeating. Okay, so we now know that the inflation has peaked about 9 months ago. It's already more than the 6 months period on the thing. But because now the inflation figure is much higher than the previous time, so likelihood there will be another few more months to go before the Federal Reserve really implement that. And of course, if that happens, then the US dollar will have some issue because the dollar will actually plunge. So all these things will push and make the S&P, make the Dow Jones lower. And that's my concern factor now because the velocity collapse negative for stocks. Remember that when velocity collapse, right, stock market will suffer because the money growth now will keep falling because bank condition will tighten. And obviously now the SVB issue now, definitely the banking crisis will continue. Therefore, the tightening will continue. And all this will basically lead to recession because it has been proven again and again, when this number hits negative figure, recession is always near. All right, it's something that you cannot run away from this. So what if we have a recession? What if we have a rate cut? Then what's the statistics are looking at now in terms of the downside? So remember, I told you this chart earlier, right, to watch out for this. The usual average downside is about 34%, and the time period is about 11 months or so, right? So let us see this chart right now and be careful, guys. Things can get very scary. Now take a look. This is the S&P chart with the Fibonacci retracement. Now this is something that I basically share internally, so I can now try to share this with you. So I put the highest point here, extend it to the recent highs, and did the Fibonacci, and you can see very incredible where the market actually rejected, rebounded. It's all at the technical point. Okay, so now if let's say this really happened, then let's look at all the important technical points to watch out for. Now the first one we're looking at is 37.65. That is the last low back in this period of time in October last year. Now many people are looking at this to break. So I also believe that that will happen. Now, if the market gets crazier, it can go down to the previous low, which is all the way back in November, and that's 34.92. Okay, these are all the cash market numbers, yeah? Then you may ask, how the hell did I get my 3,200 then? Where did I get it from? Because 3,200 is not on the screen, right? You realize that? It's not on the screen. So where is this 3,200 coming from, right? Okay, so let me tell you now how I get it, okay? So let's take a look at my sharing. Take a look. Now, basically, I take the highest point is 48.18, okay? And I multiply by 0.7. Why 0.7? Because it's a 1/3 rule. Now, 1/3 rule is pretty normal in the industry. So that will lead to 33.72. Okay, that's how I get my 3372. Now, why I need to do it by 0.67? Because remember, I told you, right, on average itself, the average Dow our average bear market is about 33 to 34%. So I take the lower number of 33. So 4818 multiplied by 0.67, I get my 3228. If I actually do it lower, 0.66, I'll definitely get 3200 level. So that's the reason why I felt that this may likely be happening. Now, of course, it means that by right, I will expect to see this, a bigger wave of selling soon, okay, a bigger wave. Then, of course, there will be a capitulation period, usually that will happen. And then after that, we will have the point whereby the market technically or mathematically rebound. Now, that is the market bottom. I really suspect that by then, the rate cut will be implemented. Then after that, right, we will have the market either bottoming out around this area or even lower. And then after that, we should see the recovery. Now, I'm actually pretty bullish in the US market in the very late part of 2023. I believe by 2024, the market would have bottomed out by then, and definitely that with a new era and technology shares will recover the next bull again, because usually it's all right, the 4th to 5th year and to the 6th year, that is where the bull market will come back again. So if you look at this whole thing right now and you think that you also share the same feel, right, that'll be great. Now, of course, I got another chart to show you. It's a Dow Jones chart, because some people don't trade S&P. They want me to show you a Dow Jones chart. I don't mind sharing this with you right now. Let's take a look. Now, what I did is I take the Fibonacci of the highest point with the lowest point right here, A and B, and I did the Fibon. Incredible, guys, incredible. When the market recovers, right, you can see it rebounded all the way to the 61.8. Then when it came down, it stopped at the 50%. And when you basically get supported, it's fine. But once it breaks down, you saw it, it came down to the 38.2, and that number is 31,804 level. So we have seen this before, all right? We've seen this before, and the market actually stopped there recently. And when it rebounded, right, you can see it went back again to the 50% mark, which is at 32,786. So that means that this chart is pretty good. And if I expand it further, you take a look right now. This is, okay, take a look here. This area here that I'm going to draw, yeah, this whole entire area here, if I expand it a little bit to now, you can see what's happening. This is incredible stuff, guys. Look at it. Once the market loses the 50% mark, 32,786, it came back down. And the way at 38.2, it just stopped there brilliantly, as if that the market really know that this level exists. And incredible, about 6 days ago, the way it pulled back and the way it rebounded, it happened again. So that basically solidified my feel. And of course, when I saw the resistance here, I'm totally sold, okay? So that means that 32,786 and 31,804, these two numbers are very critical, very important, and most likely itself, right, it will be traded again. So let's say now the fundamental begin to break down and the markets have to come off. Trust me, guys, 32,786 will be the first support that you want to look out for. If the market actually got its sort of support, we may see it going out all up again, and this time around maybe 33,769. But on the same note, if the market breaks and goes below 32,786, then there is a chance on FIBO that the market may drop back to 31,804. Now, with the RSI very near to the so-called common resistance area, I'm not half surprised to actually have the market coming down. Okay, I'm not even half surprised on this. So guys, why don't you let me know, right, in the comment box. And of course, now I'm using my new PTP indicator called KFC, Cal Flip Cycle. We have a very strong resistance right now at 33,031. And of course, if it stands as resistance, it can turn as support, right? If it breaks, if it cannot break, it will always rebound. But once it broke, then the selling will come in. So what I did is I take a channel X and Y, I put a channel and I flip it up, right? I can see that we are now very near to a resistance, which happened to coincide with the KFC. Hence, therefore, I suspect that the Dow will be bouncing around 33,031 to about 32,500 area. So traders can basically take note of that. And for people who want to hunt stops, right, you can consider to take a note of this chart pattern. Now, the thing is this, before we go, I want to show you my TWB chart, a very powerful chart here. Now, take a look. Now, every time when there's a big sell-off, right, every time there's a big sell-off, okay, do you notice something very incredible? Is that, right, look at the KSI is turning red, my KCX will be turning blue, my KRW will be red. So as long as this pattern always start to appear on my screen, you can see evidently there will be some selling. So that is how it goes. KSI red, blue bar increasing, KRW stay red, there will be selling eventually. So now the thing is this, you may say, is it evident for that? No. There was a period of time where the market basically came down a little bit. The KSI was red. The KRW was also red, but you notice there were no blue bars over here. That means that the market is actually bullish. So even though later on it's all right, if everything online, okay, the market basically didn't really move much. And then after that, when the things turn green, the market buys up again. So now where we are now at KSI green. We are the blue bars are still around. KCX are all cyan, so it's still not a time yet. So I'm not half surprised to see some pullback in the Dow, but it would not be the type of magnitude that we are looking at. So until one day you see KSI turning red, KRW turning blue, continue to become blue, so KCX blue, and of course the KRW turns red, then that will be the selling point. All right, guys, do you think that the S&P will go to 3,200? Do you think that the Dow will go lower? Let me know in the comment box. I'd love to hear from you. This is Cal signing off. Have a great day. Bye-bye.